All right, hey everyone, welcome. It is 2 o'clock, markets are closed, everything's nice and quiet. We got lots of information today from the USDA, or let me correct that, we got absolutely no new information from the USDA today. They just decided to basically kick the can down the road on their WASDA report. So the report that we had hoped would provide us some clarity and some direction on what they were thinking is not that at all. Here's what the report looks like. Okay, here's what they did with soybeans. They ended up raising the carryout 20 million bushels. Now, for those of you that are new and don't have a lot of familiarity understanding the USDA WASDE reports, this is our summary of it. There's more lines to it. There's a lot of data that goes into each one of these lines. But here's the area that they say was planted. That's 87.5 million acres. They say we harvested 86.6 million with an average yield per acre of 50.2. And at the end of last year, we had 274 million bushels remaining. And we have total production of 4.3 billion bushels of soybeans. We're going to import 15 million, and we're going to use total, and this includes exports and domestic crush, of 4,414 million bushels, leaving a net of 220 million. So we have a bank account, we put money in it, we have a beginning balance, we use this much of it, and our ending cash balance is that much. That's exactly how you read a USDA report. It's not any more complicated than that. So our ending stocks to use is 4.98%, which is just a little bit looser than it was last month. Beans initially reacted bearishly. They went down, and then they ended kind of with some strength at the end of the day. Now let's look at what corn did, okay? Corn, they raised the carryout 10 million bushels. They did that by raising production just slightly. They actually increased use by 25 million bushels, and that came in the feed and residual column. They didn't hit exports. So what you saw was corn trade well off its lows during the day, and it actually turned positive about 30 minutes after the report, and then ended up trading back a little bit lower. And I think the reason that the market reacted a little bit positively is simply because the USDA didn't crush exports. The trader was expecting, or I think a lot of traders were expecting, a larger cut to this number because they had been cutting it for the last several months. And by not cutting it, that was initially perceived as bullish. And the other thing that I think the trade is struggling with is that this stocks to use ratio, which is simply this number divided by this number, equals this, okay? So 8.34%, and that is historically pretty tight. Usually anything under 10 is a good benchmark. Anything under 10 is tight. Anything above that is ample supply. And at 8.3%, we're pretty darn tight with a 1.18 billion bushel carryout. To put it in perspective, and this is I think the tightest we've been. I might need to fact check this, but I think this is the tightest that the balance sheet has been since COVID started and since the rally. So as the balance sheet's getting tighter and tighter, the market starts to feel toppier and toppier, which is strange, but it's also okay because that's what you would expect at the top. You would expect the most bullish information to hit at a market top, not at a market low. And when you get bullish information like an 8.34% carryout or stocks to use, that's bullish, and you start to see the market roll over from that. It's telling you that the market has already priced in all the bullish information, and it's now starting to price in bearish stuff. So let's look at how this played it out on the charts. Okay, here's a chart of December corn. I'm going to spend most of my time in corn here because I think it's really, really important. We've been talking for several weeks that we think corn is going to lead. They call it king corn for a reason, and that's because it commands all of the acreage, and it's also an energy source. So what we've seen here is since the summer low that was made at $5.62 or 561 3/4 back on July 22nd, what we've seen is this move unfold pretty impulsively. We moved up from 561 clear to a peak of 706, which is a pretty hefty rally in the corn market. We retraced over 61.8% of the entire decline from the peak of December contract all the way to the summer low. We retraced it. We've consolidated on it. And we tried to break up, count them, 1, 2, 3, 4, 5 different times into new highs here. And we've failed to break up above the 61.8% mark, which is in and of itself a bearish signal. If we were going to break through this, we needed to be setting higher highs. And what we have now is, and what we've been looking for is, are we going to make higher highs or lower highs? And are we going to make lower lows or higher lows, right? So higher highs, higher lows, that's an uptrend. Lower highs, lower lows, that's a downtrend. And that's what we're looking for. And another complicating, or two more things here to talk about whether we should view this whole piece, everything from the July 22nd low to today, as a corrective price action, or whether this is actually a low and we're correcting an up move here. The difference is, if this is a correction and an up move, then we need to move higher. If this is just a big correction, this whole thing is a correction from this down move, then we're going to come back and we're going to take these lows out. So we've been talking about this for weeks. We're not sure which one it is, and so we price has got to be our guide, and we've got to let it tell us what to do. So now I'm gonna switch charts here, and I want to show you a little bit more granular detail just how complicated this is making it for everyone. Okay, so we're price people. We like to follow trends, and we let the price tell us whether we're in an uptrend or a downtrend. We don't really rely on a whole lot of technical indicators to tell us which direction our trend is. We let price do it, and it's pretty evident, right? You know it when you see it. When you see a pullback get bought, right? Here's a good example: big pullback, buy it. Here's a pullback, buy it. Pullback, buy it. And it's been that way from 2020 all the way until last summer. And now you've got a pullback in an uptrend and a downtrend, sell it, and now you've got this big sideways pattern. Okay, what I want to do is show you the corn closed what I think is the most difficult spot. Okay, first of all, where we closed is this low. Look at all this chart support that we have back here. We have this long shadow, which means we traded into this area, but we rejected these lower prices. And we've traded all the way, and we've held support that has held the entire year, all the way back to where we first visited these price levels back in March. Okay, so everything above this level, you could sit there and say, hey, this is bullish. Because you might say, well, why didn't you sell that or that? Well, the reason is because what are you trading against? Are you viewing this as support? Are you viewing, what about this low? Well, what about this one? Well, what about this one? Well, what about this one? And pretty soon, it just stair steps your way down, and your support level is way lower than it originally was. I can look at these lows right here and say, hey, that should be our support line, because there's lots of price rejection down here at these lower levels. We should be looking all the way down here. Well, that's all the way down at 642, which is tighter, which is still quite a ways away. So when you're looking for chart support, you're looking for large areas of congestion that have held multiple times. And look at it. You got 1, 2, 3, 4, 5, 6, 7, 8. You've just got lots of chart support right here. So you could say, well, we should own it above that line, right? Yeah, I mean, I don't disagree with that at all. But I also don't disagree with this. Now we've got August, September, October, and half of November done, and look at this resistance box that I drew. Look at all these opens and closes, which are the all these opens and closes where we've been unable to hold price for any period of time, which dates all the way back to this August 29th high. We've basically never been able to sustain more than a day or two above this, okay? Here's a close above it, 2 days. Here's a close above it, 2 days, 3 days. Here's a close, 4 days. Here's a close, 2 days. And we're right back inside it. This level has been a critical level for a long time, and why? Well, look back. Here you are. Here's this little swing low that happened back in June, and that has been providing resistance to this market ever since it happened. So so the bears are certainly relying on this back chart support in order to justify lower prices. Should the bulls do the same? Well, I think we have been. I think the trade's been doing that, but today may be a different day. So now one other thing I want to show you, and I'm going to draw this back on this chart so you can see it clearly. We want to look at highs and lows. Are we making higher highs, or are we making lower lows? So I'm going to draw this trend channel on here, which I'm going to take from this peak to this peak, and I'm going to snap it to the intermediate peak. Okay. Whenever you have a trend channel like this, it can help you understand momentum, and because if price violates the top or the bottom of this, you should see an acceleration out of it. Here you go. We violated it yesterday, we tested it after the report today, and now we're right back down below it. This would imply lower prices coming, and if this is the 61.8% retracement of this larger down move, then you should expect at least the same retracement from this summer move, which takes us all the way down to 650 at 38.2%, all the way down to 617 at 61.8%. And if we were to make a full retracement, which is not uncommon, you would trade all the way back down to here. So this count is why we have been recommending having hedges in place. The inability to break these is why we wanted to lift hedges the other day. But now that we've broken down out of it, we've got them back on, because now this is all the way back in play. So to make things really, really simple and not to overcomplicate the world and rely on too much information, you've got to make it really easy on yourself. And you've got to realize that we are now trading at the lowest close since all the way back in, let's see here, lowest close all the way back since September the 2nd, which is when harvest began. And that's in spite of all of the bullish material that we've had to digest in the meantime. So you got to assume that lower prices are coming ahead. Now, we won't go in a straight line, right? We're going to have some rallies and some opportunities to sell. But the best place for a farmer to be that's holding long cash bushels with downside risk at this point is to be hedged or sold, unless we are immediately up and out of here pretty much tonight. I mean, if we're not up and out of here, by the end of the day, and certainly if this low at 658 doesn't hold, then I think you've got to be hedged, because you should expect an acceleration lower out of this channel line. Okay, that's our interpretation of corn today. I think we got to look lower. I wish we had not lifted our hedge right in here, but we did it for good reasons, because that's an awful lot of chart support that held, and we have a lot of bullish impetus. And remember, on this day, crude oil, let me pull crude up. Crude oil, we lifted hedges right here. It was up $5 a barrel. Now we're trading all the way back down. Today we're down $3 a barrel on crude, okay? So something is going on in this market unrelated to the WASDs, because crude does not care about corn. Something's going on here unrelated to just basic supply and demand, and it leans bearish. And so I think we've got to be looking to the downside, and we need to have some protection on. As a speculator, I think a good play is to start selling option premium up above here. Take your December puts out to March, or just replace them with short futures out in March, and let puts and just let these puts decay up here on top, and that will put that trade in a nice position over time. Okay, so let's look at soybeans because they're almost the exact opposite, right? As bearish as corn is, soybeans are almost pretty bullish. We've had this nice move off the low, but we've been unable to break this, what we call this TDST line, or the prior price flip line, where the prior large move originated. And we've been unable to break that on a closing basis, and happens to also coincide with this downtrend line from the summer. We've been unable to break that as well. Until we do, I think you've got to look lower on soybeans. Um, and you got to look at 1462 as a top until it breaks up above it, and then look what you've got back. Think about the corn discussion. Look what all we've got to get through. We've got to get through 1493. We've got to get through 1512. You've got to get through an awful lot of bearish chart resistance back here before you can really turn this thing higher. So I think that bodes bearish for soybeans more than anything else until it can prove that it gets up above here. Now, if it can break up above this 1512 level, then I don't know what it does. And it's almost impossible for me to understand or comprehend, and this is just, I would just call this limited knowledge or information or understanding. We're all human. We all have it. I just don't understand how soybeans can rally that much higher and corn have this kind of a move down. That does not make any sense to me whatsoever, but it is a market and anything can happen. But it makes more sense to me that beans are going to roll over. And if corn moves to new lows, do the math on soybeans, right? That's 1296. That's starting to look like a pretty attractive risk reward situation. If you're trading against, $13 against 14, let's call it 1460 into 15. That's 40 cents for almost $3. That's a pretty, or almost, what is that? Dollar? That'd be $1.50. That's a pretty nice risk reward, right? So I wouldn't be a bit surprised to see selling increase on soybeans in the days ahead if they don't break up and out of here pretty quick. Okay, that's 17 minutes. Wheat. Let me show you wheat real quick. Wheat kind of doing the same thing crude oil did. Here's the shutting down of the corridor. Here's the peace talks back on. Now we're getting more chatter out of the Ukraine and Russia that more peace is coming. Think about the last conversations with corn and beans. Look at all the overhead resistance. You got to assume that lower prices are coming in wheat, and higher prices are going to be harder to come by without some sort of catalyst or event that pushes the market higher and forces it up through there. I don't know what that would be at this point, other than increased hostilities or some unknown weather event that we need to see. So I think wheat is working lower. I think corn is working lower, and I think soybeans are also more than likely to roll over as well. So trade accordingly, and let us know if you have any questions. Remember, there is always risk in futures and options, and markets have a mind of their own and are not constrained by our understanding of them. So if something changes in price, we will let you know. Otherwise, don't trade beyond what you're financially able to withstand, and we will talk to you next week. Have a great day.